Are you concerned about the volatility in the financial markets today? Do you think something needs to be done to reduce it?
I love volatility. I remember when in 1972 the market went from down dramatically, and Taco Bell went from 14 to 1. They had no debt. They never had a restaurant close, and I started buying at 7, but I kept on to it, and it went to 1. And it was the largest position in Magellan in 1978 when it was bought out by $42 by Pepsi-Cola, and I think it would have gone to 400 if they didn't buy it out. I think volatility is terrific. I think these callers are very important. I don't think the market going up 80 points one day and down 80 the next is a good thing for the public. I think that's not a very good thing. But I think all of these callers and all these other things, to keep the volatility down each day is important. But the market's going to go up and down. Human nature hasn't changed a lot in 25,000 years. And some event will come out of left field, and the market will go down or the market will go up. So volatility will occur, and markets will continue to have these ups and downs. I think that's a great opportunity if people can understand what they own. If they don't understand what they own, they can own mutual funds, try and figure out what mutual funds they own, and keep adding to it. Basically, corporate profits have grown about 8% a year historically. So corporate profits double about every 9 years. The stock market ought to double about every 9 years. So I think the next market's about 3,800 today, 3,700. I'm pretty convinced the next 3,800 points will be up. It won't be down. The next 500 points, the next 600 points, I don't know which way they're going. So the market ought to double in the next 8 or 9 years. It ought to double again in the 8 or 9 years after that. Because profits will go up 8% a year, and stocks will fall. That's all there is to it.
We're in the month of October. Beware of the month of October, the witching month for the stock market. What do you see as the outlook for this month? And when do you think the Dow will hit 4,000?
Okay. October has always been a special month. I remember in 1987, I was very, I was very convinced that the market was not in trouble, and I didn't worry about things. And Carol and I had planned this great golf vacation to Ireland, and we were going to visit one course and stay at a little house and visit another, go all along the west coast of Ireland and play golf. And we left on a Thursday night, and the market went down 55 points that day, which was not too good. And the next day we got to Ireland, because of the time difference, we'd completed our day, and I got back to the hotel and I called in. The market had gone down 112 on Friday. And I said to Carolyn, I think if the market goes down on Monday, we're going to have to go back. And so we stayed there for the weekend. And on Monday the market went down 508 points, and my fund went from I think 12 billion to 8 billion, and that gets your attention, in two working days. I said at the end of this week I'd be have no fund. Now there wasn't a lot I could do. I mean, here I was on Monday, because the market didn't open. By 12 o'clock it was in Ireland. It was still 7 o'clock in New York. So we did spend that day, and we played around golf in the morning, and then we went somewhere and sort of watched the market deteriorate. And I did come back. There wasn't nothing I could do. I mean, just nothing I could do about it. But I think my shareholders, they called up and they said, "Well, what's Lynch doing?" They said, "Well, he's on the 6th hole, and he's he's even par up to now, but he's in a trap. This could be, this could be a triple bogey here. This could be a big inning." And I don't think that's exactly what they want to hear. As though I could do something about this damn thing. So I came back home and suffered with everybody else, and fortunately I was very consistent. The market went down when I ran Magellan. On 13 years, the market went down 9 times, and every time the market went down, Magellan went down. I was 9 for 9, and because it's very important. This is another one of these numbers you ought to write down. If you put $1,000 in a stock, all you can lose is 1,000. I've done that several times, and but if you're right, you can make 5,000, 10,000, 20,000. So this business, you don't have to be right 1 out of 2 times. You can be right 1 out of 4. As long as the times you're right, you know the company's doing well, you know they're doing a great job, and you add to it, or at least you don't sell it, which is a terrible tragedy. So you can make more money on the upside. So I just wrote those out, and I will now flip a coin to tell you where the market will go to 4,000 this year or next year. Heads means it goes up. It's a 2-headed coin. the market will go up in the next year. That's it. That's all I ever know about the stock market.
As Peter Lynch described, volatility on its own isn't a bad thing and can actually be a pretty powerful tool for improving investor returns if you have a strong enough stomach. Now, when we talk about volatility regarding stocks, there's usually two main discussions: the price volatility of an individual stock versus the price volatility of the stock market or an entire investment portfolio. When investing in individual stocks, it can sometimes come as a disappointment if you buy a stock and then see its price fall. However, it's important to distinguish between price and value. While the price of the stock may change very quickly in the market, the underlying value of the company, which is based on the performance of the underlying business, usually doesn't change that quickly. So all else being equal, if the fundamentals of the company haven't changed and the only thing that's really changed is the stock price, well then if you like the stock at $24 per share, you should love it at $17. For most quality companies, stock volatility that creates meaningful price declines often turn out to be great buying opportunities in hindsight. We saw this exact occurrence in March of 2020 during the peak of uncertainty and volatility. Some individual stocks like Discover Financial saw periods of extreme volatility and significant stock declines. In the case of Discover, it was down well over 50% in just a few weeks, dropping below $25 per share, a price not seen since 2011, 9 years ago. Now, while there was some justifiable uncertainty surrounding the future at that time, for those that looked at Discover's balance sheet and underlying business, they would have seen that the company was actually well positioned for whatever may lay ahead. This extreme price volatility created a great opportunity for investors who could purchase a company which was temporarily trading at a price significantly below its true intrinsic value. Now, prior to March, I had previously purchased Discover's stock for about $70 per share. And when I saw its price decline by more than half, yes, the value of my position had declined by half, but now I could purchase twice as many shares for the same amount as my initial purchase. So that's exactly what I did. I ended up purchasing more shares of Discover at around $35 per share, and then one more time around $45 per share. Since then, investors have appeared to realize that the underlying value of the business is actually worth a lot more than $45 per share, and the stock is currently trading at around $90. And this is just one example of extreme price volatility that created opportunities during that time. Lowe's was another stock that saw a decline of over 50% and was a great opportunity for investors to add or initiate a new position. Even a fast-growing company with no debt on its balance sheet like Facebook saw its price decline by over 1/3 very quickly during the crisis. And while sudden volatility or price declines may be frustrating for investors who just purchased prior to those declines, as long as you're paying a price less than the underlying intrinsic value of the company, you should do quite well long term. Even if you had bought Facebook then at its previous all-time high in January of 2020, while you did experience a temporary price decline, you had the opportunity to add more shares at a lower cost basis, which ultimately would put you in a better position than if the stock only continued to rise. And that's one of the key takeaways when it comes to volatility. You need to make sure you're able to handle it. But if you do, as a long-term investor, you will be better off in the long run because that stock price volatility allows you more chances to buy companies at attractive prices. That being said, when thinking about the volatility of your entire investment portfolio, there are a couple aspects that make it a bit different compared to thinking about the volatility of an individual stock. One difference is that when the price of an individual stock goes down, you can use some cash either from your income or potentially from a cash reserve in your portfolio to then buy that stock if you think it's an attractive price and good value. And if you didn't have cash available, you have the option of selling off some of your other positions, potentially that may be a bit overvalued or fully valued at the time, to raise cash for that new purchase. However, when your entire portfolio experiences price volatility, unless you have cash set aside specifically for a drawdown, you might not have much potential to take any new actions beyond new contributions from your income. And if you're at a point in your life where you're actually withdrawing from your portfolio and no longer making new contributions, your actions may be limited to cutting expenses to minimize further reductions in portfolio value during the drawdown. This leads to the second distinction that declines in your total portfolio will likely have a greater mental and emotional impact than declines from a single stock. This is especially taxing if you have a low risk tolerance or tend to lose sleep when your portfolio sees a large decline in price. So you should make sure you have an answer to these important questions when it comes to your investment strategy to be fully prepared for future volatility. One of those questions is, are you going to take action to reduce the volatility of your stock investments by adding other non-stock investments to your portfolio? Adding non-correlated assets like gold or cash, either as a permanent or temporary asset allocation within a portfolio, can help reduce the overall portfolio volatility during periods of stock price declines. One of the best tools to help answer this question is a free website that I love called Portfolio Charts, which has the best visualizations for understanding risk within a portfolio and the impact that different asset allocations have historically had on portfolio drawdowns. By potentially sacrificing some upside potential within a portfolio, you can make significant reductions in the potential volatility of the overall portfolio, or be potentially used as a shorter-term tactical allocation to be a bit more defensive in your portfolio to wait for a more opportune time before reallocating to a more aggressive strategy. Investing only in a total stock market index like the S&P 500 historically has had some of the best returns of most modern portfolios. That being said, it also has some of the worst risk characteristics, including both the deepest and longest drawdowns in the portfolio. Now, some investors have made the conscious decision to embrace volatility in the pursuit of higher returns. And there is nothing wrong with having an aggressive portfolio so long as you understand that there will be price declines and periods of underperformance that you will have to stomach. Once you really understand volatility, you come to expect it. It doesn't surprise you anymore, and it shouldn't really concern you because you already have a plan in place, tuning out the noise as much as possible and continuing to add to quality companies and assets when prices are down and attractive. Overall, I hope you enjoyed the wisdom and perspective from Peter Lynch and got something from this video. If you haven't subscribed already, consider doing so as I have more content coming in the future. And until then, thank you so much for watching. My name is Michael, and I will see you in the next video.